So the game plan is for us to grow ourselves out of debt. Questions? I have a question. No, actually, that's a lie. I have a statement. The government spent over $5.3 trillion this year, and we still have 1 month in our fiscal year. Yeah, you got to spend money to make money. Anyone else? It's me again. I have another statement. Economic growth is slowed by 30% when the debt to GDP ratio exceeds 90%. What's your point? Sure, we're at 125%. That could be a problem. Hey guys, welcome back to the After Hours. I'm the 8-Tailed Beast, and today we're going to talk about nightmares in the market. So let's get into it. The holidays are approaching fast, and 'tis the season to be spooky. I think some people are taking it a little too far. Now the media
is 90% bullshit, but it's entertaining. That's why I read it, because it entertains me.
Is pushing that inefficient labor is going to cause a crash in the economy. Not the Fed, not monetary policy, not government policy, but you. In other news, the UN says it's monetary policy. They're also saying they're worried that the central banks are going to hike us into a recession, global recession. So the UN is worried that the rate hikes of 1 point will appreciate the dollar to the point where it kills the economic output in developing countries and even more so in underdeveloping countries. Now the central banks, including the Fed, they fear if we choose not to rate hike now, it's going to affect the global future growth. We're really being put in a damned if we do or damned if we don't situation. At this point, we're just choosing the lesser of two evils. Now the UN might be onto something, because the Fed is on track to deliver its steepest hike cycle in decades. Since we're already looking at the past Fed performance, if we look at the former Secretary Treasury, Larry Summers, he sees that today's market risk is similar to 2008. Now, if you go back to the person that accurately predicted the crisis of 2008, Michael Burry, he fears that the disaster is going to be even worse this time. It's been said that the rate hikes are causing dysfunction in the equity markets, but even more so in the credit markets. Now we're fighting against 10 plus years of financial conditioning. After just coming out of a pandemic, we're going to experience some kind of pain. Now all levels of government are doing their best to recover losses from the pandemic. Local governments are recommending windfall taxes on high profiting industries like the oil industry. And you see that with Governor Newsom taxing oil companies during a fuel crisis. You can also see it in big government when President Biden proposed that we double the IRS agents' workforce as a part of a plan to snag the taxes that have been avoided by cheaters. Now, after this, 5 IRS agents were charged with COVID relief fraud. And after an investigation, 1,200 agents were willfully delinquent. This is at the same time that Biden is hiring 85,000 new agents to help audit taxes.
Sandra, and some of the excuses these agents used for not paying taxes, it was too complicated to figure out.
So that was funny. Not gonna lie. On to bigger problems. On Monday, the U.S. national debt just reached an all-time high of $31 trillion. Now, we have always been in debt just because we have a unique consumer culture, but more immediately, the national debt is a big problem for the Federal Reserve. Now, the government can't keep borrowing and stealing. Now, the government can't keep borrowing and spending money without the Fed monetizing debt because the central bank has to buy bonds to prop up the demand. Without the Fed's intervention in the bond market, prices will go down, interest rates will go up, and the US debt will raise even higher. Now, in the long run, this strategy of buying and borrowing is going to cause inflation, and then inflation will drive the people to lose faith in the dollar. Now, optimistic investors are looking at the pivot in the pound after the BOE, the central bank in Europe, they recently started buying bonds, and they expect the Fed is preparing to do the same. Now, this comes from Mohammed El Aaron, an economist at CNBC. He says people are obsessed with the Fed pivot, and normally you don't have the Fed to come to the rescue unless you have an economic accident or market accident occurs, and you don't want that. Now, speculators are putting the predicted shock to be on a global scale, similar to that caused by the bankruptcy of the US bank Lehman Brothers back in 2008. And to cement the fear of the large amount of risky bets in the market, the social media coined the recent term Lehman moment. More importantly, to tame inflation, the Fed must increase rate hikes, which will increase yields and increase the risk for credit defaults. Now, social media and the rest of media,
90% bullshit.
They figured out which one is going to be the closest to the Lehman moment that they want, and they chose Credit Suisse. Now back to economist Mohammed El Aaron. He says Credit Suisse is not a Lehman moment, but I'll tell you what the speculators see. Now Credit Suisse is the #2 Swiss bank and one of the largest banks in the world. It's an investment bank that has a history of sketchy deals and scandals involving everything from defaults, spies, lies, fraud, and who else knows what. Now right now, it's a part of the latest credit scandal, and this came after a sudden spike in their credit default swaps. Now, a credit default swap is a CDS, which is a form of insurance against a default. Now, to put things into perspective, over the year, this stock has dropped over 50%. And after this recent scandal, it's dropped 8% just in the last month. Now, overall speculation around the bank and its inability to restructure its business has investors anticipating a negative outcome. It's gotten so bad to the point that the rating companies have downgraded the initial rating on the bank itself, having investors leaving billions at a time. Now, what the investors are paying attention to is the bank's stock price. But if you go back to economist Mohammed El Aaron, he says the stock price of the bank doesn't directly correlate with the ability of the bank to do its normal lending functions. When you ask the higher ups in the company itself, the conditions from 2008 and now are completely different. More money is held inside of the bank itself in case of an economic crisis. Now, at the beginning of the year, you had the chairman leave, and he was replaced by a chairman called Axel Lehman. Now, when people chose their Lehman moment, they were careful. But in recent days, the company has been real gloomy because the departures have no longer been replaced. And overall, that affects the company's mental health. Now, talented employees have been leaving at a fast rate. You had executives and senior deal makers leaving for better opportunities. And just recently, you had the vice chair leave for a better opportunity. This company is coming up on its third quarter earnings, and so they don't file bankruptcy, Credit Suisse has promised to present a strategic plan October 27th. In addition, just to calm the investors and speculators, Credit Suisse also offered to buy back $3 billion of its own debt, just so it can prop up its stock price. That shows how committed they are. Now, if this bank goes under, who's actually at risk? We know this would kill the momentum of all investment banks in general, but if we take a closer look, we'll see the largest investor is BlackRock. And we know BlackRock, they own pretty much everything. Now, BlackRock holds assets in the name of customers, so BlackRock doesn't really own much, but they're a part of everything. Now, if this bank goes under, we know it's going to cause a chain effect, and it's going to be worse than most nightmares. All right, guys, that's all I got today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.